Good afternoon, Mr. John Dielwart. Thank you very much for doing this. I really appreciate your time.
Thanks, Trevor. Appreciate being here.
Nowadays, you are the chairman of TransAlta and also a member of the ARC Financial Investment Committee, I think.
Yes.
But before that, you were the co-founder, CEO, and director of ARC Resources from about 1996 to 2013?
Correct. And I stayed on the board for another 8 years, which is rare when the CEO retires. So I really had 25 years there.
We've also spent the last 20 minutes doing audio, video, bug detection, so I'm a little sweaty. Apologies for that. But
All good.
My heart rate's up, hopefully not yours.
Not mine.
Did you catch the Blue Jays
Oh,
game
yeah.
last night?
I was actually driving back from BC last night listening to the game. Awesome. It's phenomenal.
I'm not a baseball guy, but it was great to see George Springer hit the home run in the seventh.
Well, the thing about it is that's cool. Like, baseball's a really difficult sport in my mind to track all year. 162 games is just way too many. But when it comes to September and October, there's nothing like it.
Mm-hmm.
And real baseball fans will say, and it was last night was the exact case, you're just one swing of the bat away from success or failure. And when it goes your way, it's fabulous. When it goes the other way, it's devastating.
Yep. Despite the problems in Canada, it's also kind of a unifier too. Canada's team, it seems like.
Well, it's nice when you hear the Blue Jays talk. They understand that their support comes from across Canada, all 41 million people, not just the Toronto area. So it's fantastic. You know, they're in tough against the Dodgers, but at least they're there.
You never know.
I was actually just in Japan with a bunch of friends, and we were on a cruise, bunch of ex-oil patch CEOs, in fact, and we were watching the game, streaming it while we're touring cities in Japan, and we're watching pitch by pitch as it goes on.
The one guy from Seattle, Wu, I think, is from the pitcher. I think he's from Japan or something like that.
Oh, that's for Los Angeles.
Okay.
Shotan Ohtani.
Yes.
Unbelievable.
Yeah, good talent.
Player. He'll be tough.
Right.
Yeah, they had a stat on him in the final game of the National League Championship Series. He pitched, had 10 strikeouts, hit 3 home runs. Mm-hmm. And they said the number of pitchers that in their entire career have hit 3 home runs and had 10 strikeouts is 1. And he did it in 1 game. And so he's a joy to watch, actually.
Well, that's baseball.
Yeah.
But maybe to get back to your career in ARC Resources and everything else, to start at the beginning, I think you're from Calgary originally?
From Calgary, and it's, it's interesting. The road up to ARC Resources is quite interesting, and it's something that, I reflect on from time to time because I was born in Edmonton, but we lived there. My family was just transitioning. They left post-war Europe, immigrated from Holland. My 2 brothers and sister were born in Holland. I was born here, and then my father passed away when I was 2, and we just happened to still be in Calgary. He was a traveling salesman, and so we've been in Calgary forever. Mm-hmm. And it's funny how decisions made or not made influence things. My mother, for reasons I don't understand, but I'm infinitely grateful for, stayed in Canada. She was the 18th of 19 children. She could have gone back to Holland and had a huge support structure. Mm-hmm. Chose to stay here. I'm an anomaly, and in my entire lifetime, I've never met a grandparent, an aunt, an uncle, a cousin, not a single relative, but it was the best thing for us. And I ended up in a city like Calgary where the opportunities were unlimited. Even for someone that really, we struggled as a family to get anywhere, and coming out of high school, no job, no prospects, what do I do? And here I am 50 years later, and have been able to carve out a pretty nice career and provide a good life for my family, which was most important.
19 siblings.
19 siblings, yeah.
That's unheard of.
Yeah, and they were in, obviously in Holland during the war. All 19 survived, which was shocking. And, but it took a toll on them, and my mother would never talk about it. She just never talked about what happened during the war. But obviously, if you've got that many family members, they were quite wealthy, lost it all. Had a big home that ended up, the Germans took it over as a headquarters. They lived in the barn, and I can't imagine what life was like, and they'd never talk about it, and we stopped asking.
Yeah.
But Canada was a land of great opportunity. We're very fortunate to have ended up here.
Point is that you had to work pretty hard and kind of started, but you ended up doing pretty well on ARC Resources and everything else.
Yeah, and it's one of the things I talk about to people, that once we've achieved our success, we have to help others achieve theirs. And as I look back over all the years, the number of people that gave me a little nudge in the right direction or a big push in another direction, and a slight deviation from that path, and the things are a lot different. And I was reflecting on that recently and thinking about all the steps and even who we knew and how we knew them, that created opportunities. But then the big thing is, when you see an opportunity, seize it, go hard at it, take the risk, get the reward if it's there, and if you fail, you pick yourself up and keep going. And that's what Alberta was all about over the last 4 or 5 decades. It's still there, but the opportunities are a little more constrained because the government's much more involved in trying to constrain things. Not necessarily the provincial government, but thereabouts. But, getting out of high school, I didn't know what I wanted to do. I didn't have a clue. And couldn't afford to go to university. And a family friend got me a job at the Oil and Gas Conservation Board. Later became the Energy Resources Conservation Board, et cetera. And I always remember this. I was so excited because my salary was going to be $250. I said, $250 an hour? That's like almost $400 a month. No, it's $250 a month, which is $1.75 an hour, but it was a job. My role there didn't even make it onto an org chart, but I met my wife of 52 years there. 3 years later, I went to university and then seized on opportunities as they developed.
So you did your engineering degree at the UC.
UC, civil engineering. My thought process on civil is I probably want to work in the oil and gas sector, but if not, every city on the planet needs a town planner, city engineer. So optionality, that's what that was all about. But it was pretty clear. I'll never forget, I was interviewing with the Department of National Defence in Canada. And they had a pretty intriguing job offer as a civil engineer working in their infrastructure. And they said, well, here's what you'll be making now and in 5 years and 10 years. And I said, well, what if I work twice as hard as the next guy? Well, you'll still all be making this. So I said, well, okay, that's pretty much Shell had an offer on the table to me, and I just signed up with Shell, and best decision I ever made. Great company, great opportunities, great people.
So you started your career at Shell?
Shell, 5 years at Shell. Had great, I wouldn't call them mentors, but I would call them people who really cared about me as a person and my development. The one thing I knew was I didn't want to become a subject matter expert. And I had hoped I could just kind of progress through various different departments, learn a little bit about everything, but not a lot about anything, if you will. And Shell didn't really do that back then. But I made the case to supervisors, and they allowed me to move through multiple different jobs, ending up as a reservoir engineer. And lived through the National Energy Program, which was the first of many big bumps our industry had. I'll never forget that day. I was working, I'm a reservoir engineer now, and I'm doing all the exploration model economics. National Energy Program comes down, and we shut down everything.
Yeah.
All exploration stopped. That was it. Shell was looking at, do we even belong here? And then we climbed out of that hole, took some time. But things change in a hurry that are beyond your control. So how do you adapt to them? And that's the secret. And that's kind of the secret of ARC's success.
Being at Shell in the 80s/late 70s sounds like a great place to have been. There was a lot of CEOs that have come through there.
Well, Shell, the beautiful thing about the industry back then is, as an engineer, I really say what engineers are, they're trained to think through problems, problem solve. So I'm a civil engineer going into the oil and gas sector. I had a job in construction to begin with, but nothing I learned in engineering really set me up to be a reservoir engineer, which is where I kind of ended up. Mm-hmm. But Shell had a magnificent training program. Mm-hmm. And so basically you get out of university and you go to their university. And over the course of 5 years, I probably spent 6 months in a classroom, but they trained the industry, they and a couple other big companies.
Yeah.
Of course, eventually they found they were losing all their good people to other companies, so maybe they're training them too well. But the people I met at Shell were the backbone of ARC when we finally got around to doing it.
I think Mike Rose was there too. And
Mike Rose was there. I didn't know Mike at the time.
Brian Schmidt.
Brian Gould. I chair the company Brian Gould created, Aspenleaf. But it was interesting. In 82, I decided to make a move to what was then Kolesnik Fork Pinnell Associates. Now it's GLJ Petroleum Consultants. And so I spent 12 years as a evaluation engineer, and we just had our second child, 2 small kids, and I'm doing well at Shell, but a friend of a friend, actually it was my wife's best friend, who she was dating now, her husband was Daryl Gilbert of Gilbert Lawson Young, et cetera, Coles Gilbert. And I was talking to him one day, and he said, you should come over and work with us. It's great. I said, well, what are you offering? He said, well, this, and a company car. Sold. I need a new car. I got 2 kids. So there wasn't a lot of thought that went into that move other than I knew I wanted to make a move. And yet that decision about I need a car, I can get a company car, let's give it a go, that created the foundation for everything that ARC Resources is today. Mm-hmm. Because over the next 12 years as a partner, and I ended up a senior partner, we evaluated everything in the basin. And I got a clear-eyed view of which assets continue to perform over time and which ones you just don't want to have too much to do with. And that learning over those 12 years, I guess, set me up for the type of assets we wanted to own at ARC Resources.
So 12 years into your GLJ, you would have been early 30s when you started at ARC Financial?
Yeah, I was, when I finished my career at GLJ, I was 41. So I was there from 29 to 41. And I'll never forget the conversation I had with my wife, and now we've got 4 kids and doing well as a consultant, working really hard, earning a good living. But when you're paid by the hour, when you take a week off, you're not getting paid. And I'll never forget, I'd come across Mac Van Willigen, who you've had on your podcast. One of the finest gentlemen, greatest Canadians, greatest mentors I could have ever hoped to have. And I think it was around 1992. Yeah, about 1992, I came across Mac. I had done an evaluation of Sask Power, who owned some oil and gas assets. And Sask Oil was also one of our clients, and someone else had done that. And I remember getting a phone call, I think it was a Tuesday afternoon, 3 p.m, and it was the CEO of Sask Power saying, you have to be in Regina tomorrow morning, 8 o'clock, for a meeting. So I picked up my briefcase, headed to the airport, and found out the next morning I was going to go toe-to-toe with Mac on the valuation of Sask Power, Sask Oil. What had happened was I had given a fairness opinion, what our firm had, on what we thought Sask Power's assets were worth. And they were close to signing a deal to combine SaskPower, SaskOil, which made infinite sense at a lower value. And then Esso bought Ocelot Resources with very similar assets. And it validated our numbers. So suddenly we get thrown into the fray. And if you know Mac at all, Mac is the most prepared human being on the planet. He doesn't walk into anything not fully prepared. And I just walked in not knowing what was going on. So I always kid him. I walked in with a notepad and he walked in with a stack of, what did they call them back there? The things you put in the overhead projector. He had slides, he had everything. And over the course of the next couple hours, we had a bit of a to and fro. And Mac has a different view of this, but my view of the outcome of that, he knew he couldn't beat me, so he needed to hire me.
Right.
And so a couple of years later, they came and made me an offer.
Okay.
And I remember going home and telling my wife, I'm going to make a move. We're going to make more money, right? Well, no, I'm actually taking a cut in salary, but I will be an owner in the company. And what we'd all like to do is make money while we sleep. And so there was a great opportunity, and never knowing that ARC Resources would be the outcome of that moment.
Right.
It was Power West Financial at the time. We were co-owned by Power Corp out of Montreal and the employees of Power West. I think I was employee 10, 11, or 12, something like that. Mm-hmm. And they'd hired me to help start a small, non-operated production operation. And that evolved into some work on we were doing on the M&A front that evolved into the trust. And again, it was just clear-eyed vision from our founders at ARC, Mac in particular, but also John Stewart, Phil Swift. Mm-hmm. And we decided to focus more on the capital side. Mm-hmm. And we had advised the Alberta government on the sale of their, I think it was 12.5% interest in Syncrude. And out of that came Canadian Oil Sands Trust, I think it was. And we'd helped create this trust. And then we looked at it and we said, well, that's actually a pretty good business model. And Pengrowth, Enerplus were around, but they were different. And in the course of us trying to build this little non-op production business, which was really small, a couple thousand barrels a day, Mobil was selling a bunch of assets. And Mac and I looked at that and we said, well, we could probably build an energy trust out of these assets. Mm-hmm. So First Energy was handling the transaction for Mobil. That's when I met Brett Wilson and Jim Davidson, who are good friends to this day. In fact, I was just in Japan with Jim. And we pitched the idea to them, and they pitched it to Mobil. And they said, well, it's a great idea, but we got to run a beauty contest. We got to talk to several people. And fortunately for us, they thought we'd do the best job. So we started the process of let's build a trust. The problem we had was the assets that were available for sale were the worst possible assets for a trust, short life. Mm-hmm. So over the course of about 6 weeks, to and froing with Mobil, we ended up creating an entirely different package, but doing an IPO of ARC Resources.
So you got to ARC Financial and you were there for a couple of years doing non-op work, but
yeah, I was basically their technical guy, and we were doing work with. We had Power Corporation was funding one business that we were building, and we had another little small business, but it was all little stuff. But and again, I've been blessed to have people like Mac as mentors. They saw clear-eyed. The interesting thing that not a lot of people understand is, I think it was 1993, Power Corp told us that, we're doing great with you guys, but you're so small, we want out. So we did a management buyout, and we had to change. They wanted their name back, so it couldn't stay as Power West. Mm-hmm. And Mac might have told you this stuff, so we couldn't come up with what's the new name of the company going to be? And ARC is an acronym for Advisory, Research, and Capital. Right. And we did M&A advisory work, research, and the capital side was what I was doing in oil and gas. Plus, we had an investment fund. And over the course of time, we were advising clients. And Mike Rose's first company, Berkeley, we put one of our investors into that early, and it was a triple grand slam home run.
Yep.
And we thought, why are we making all this money for other people? And we said, well, let's try to do this ourselves. And over time, we got out of the research business and internalized it. And again, you won't have this happen very often. At ARC Financial, the biggest source of income we had was our M&A advisory work. And I think we were by far the largest in Canada, but large meant we had maybe a 20% market share, and the next biggest was 12 or something. Came into a partners meeting unannounced, and Mac, Phil, and John said, we're getting out of the advisory business. But that's where all our income comes from. No, we're going into the capital business. We're going to be investing our dollars along with investors' dollars, and we're going to build a production business, and we're going to build investment funds. But there's not many people would have that conviction to say you're going to leave something that you're very, very successful at, and you're convicted that there's a better opportunity. And they were right. I could have never seen that coming.
So the idea was that although M&A advisory research was going well, there was more opportunity in owning the production. And
well, and I don't know how to say this without being crude, but you ended up working in the M&A for a lot of people that maybe weren't as smart as they thought they were. And they often treated their consultants not quite like you'd like to be treated. And we just thought, why are we doing this and helping everybody else make money? We can take that knowledge and put it to work elsewhere. And the very last big M&A advisory role we had was the one I mentioned, the sale of the Alberta government's share in Syncrude that created Canadian Oil Sands Trust. And it was after that we said, and then the mobile assets came up. We said, let's build a trust. And it was pretty audacious, quite a challenge. And I think the mobile deal was $225 million for the assets. We needed to raise $200 million, and we had $25 million of debt. The one thing Mac drilled into me was, debt is your enemy. Your banks are your friends when times are good, but debt is your enemy. So we were very conservatively capitalized, and we went cross. And other interesting story, I'd spent all the time negotiating the assets. We finally got to the point where we got the assets. We hired RBC to be our lead bank, and it was the best efforts fundraising to try to raise $200 million. And my first read of the prospectus, I'm looking at the org structure, and Mac was CEO and I was president of the company. I said, well, I didn't know that was happening. That's pretty cool. So we went on the road, couldn't raise 200, but we got to $180 million. And we're able to manage the ROFR process. So the other $20 million, we basically sold some assets to the right of first refusal process. And not knowing whether or not we'd be successful or not, suddenly we had 10,000 barrels a day of production, which is what the assets were. And there was myself, my executive assistant, and I had a part-time land person, Susan Healy, who became a key part of the team. And suddenly, holy crap, I got to build a company here.
yeah.
And so I took the reins of trying to build a company. Mac handled all the interaction with the banks and everything. And the challenge we had was trusts were not really operating. They were more financial engineered vehicles. No criticism of Pengrowth or Enerplus, but it was a different model. Whereas we looked at it as it was a superior business model than the normal, especially the junior mid-cap sector, where you just reinvest every penny you've got and grow the business. And inevitably, you'd grow the industry, then prices would collapse, and everything you've made for your shareholders you lose, and then you start it up again. So we truly believed that the trust model was a superior model for capital discipline, for returns to shareholders. But not everyone saw it that way. You know how many institutional shares we sold in our 180 million?
I read that.
Zero. Not one penny would be invested by the institutions. And it was, and I said this to Brett and Jim at First Energy, they got 8% of the syndicate. And through all of their hard work and efforts, they still weren't able to sell any of ARC Energy Trust stock to a institution. So we were 100% retail owned. We probably had 50,000 shareholders. Nobody more than a couple percent, if that. But over time, and we built the company, like I said earlier, the experience I had with what is now GLJ, evaluating assets, we were the classic resource player long before it was,
you could see it.
What's the word, cute to be resource player, long before it was in fashion. So we made Pembina-Cardium our primary area to try and own, and we got a lot of it from mobile. And the way I always talk to shareholders, if you get a big in-place resource asset, and I'll come back to it when we get to the Montney, then time is on your hand, commodity prices, technology, and I would say in the Pembina field, maybe at the time the average recovery factor was going to be 30%. We'd already recovered 28%. If we can bump 30 to 31, our remaining reserves go from 2% to 3%. Suddenly you've increased your reserves 50%. And that's what we were able to do with Pembina. So our thesis for ARC Resources was big in-place resource properties that allowed you would always own it. It's just a question, what can you get out of it? And time, technology, pricing. When prices were good, you go harder. So we also got heavy into shallow gas, which is the ultimate, at the time, resource play. And then we just built the company through M&A work. And the purity of the model that our critics failed to grasp. Like if I had a nickel, as they say, for every time we were called a Ponzi scheme, I would have done very well. But we weren't a Ponzi scheme. We'll reinvest enough to sustain the business, and you get all the money back. And if we want to go out and buy something or grow, we're going to come back to you and ask you for money. And if you don't think we should do it, you won't invest with us. So the capital discipline component, and ironically, if you look at where the oil and gas industry is today, what is it? Stay flat, return capital, either through dividends or share buybacks. Well, that was the ARC business model in 1996. And over the course of my tenure and beyond, we were very risk averse in terms of we had to manage risk. We did that quite well. And over the course of time, we were one of, if not the top performing stock. But getting back to, it was the middle of Stampede Week when we closed our IPO. So the first thing we did was go out to the bar and celebrate, as we all did back in the day. And the next morning I woke up and I said, okay, I'm now running a public company. I have no staff. I got to build the company. And over the course of time, we made several key hires that Susan Healy, who was magnificent, she was our part-time land person helping me out at ARC Financial before we did ARC Energy Trust. She'd had senior positions in the industry with various big companies, and She was working, she owned a flower shop in Vulcan, Alberta, and she was kind of itchy to get back in to the industry. So we brought her in as a part-time consultant. I said, don't worry, Susan. We'll never be a big company. You don't have to worry about that. Well, we became a pretty big company, and she was one of the most important people we had because she helped build our whole land system. She was our administration. She was even my executive assistant. Suddenly was answering investor calls from individual shareholders. Steve Sinclair was the CFO we hired, and he was my CFO for my entire tenure there. Steve, you're the expert. Go build us an accounting department because, oh, by the way, our first quarterly report is 3 months away. Steve did a magnificent job, built that. I had nothing to do with that whole side of it, but he was such a capable and competent person. I didn't have to worry about anything financial reporting. So then we're looking, and we need reservoir engineering help. And there was a particular individual who had the office beside me when I left Shell, Doug Bonner. He'd moved on from Shell. He went to Amerada Hess. Petro-Canada bought Amerada. And he wasn't sure whether he wanted to be with Petro-Canada. And we approached him and said, Doug, we got a deal for you. Yeah, we're an energy trust. Yeah, people might not think we're the best business model, but we got a great opportunity if you're prepared to consider it. And he did. And he was the brains behind evaluating all the assets. I was pretty good at identifying what we should be interested in. He was brilliant at creating the structure, making sure that we properly understood the assets. And then the last one, who was on your podcast, Myron. I think the thing that we did best at ARC Resources, I'll refer to it as ARC Resources, but it was ARC Energy Trust with ARC Resources as the company underneath, but ultimately ARC Resources. And this was, again, mentorship from Mac. The decision we made was we didn't want to hire the best person available at the time. We wanted to find the best person. And sometimes it took time. So when we did the mobile deal, we signed a 1-year operating agreement. So they would continue to operate. It was about 75% non-op, 25% operated. They would continue to operate. But by second week in July, we're taking it over. And now it's probably March. Still don't have an operations guy. We'd interviewed a bunch. There were a bunch of really good candidates, but I never really got the sense that this was the guy. And round about then, Myron, who he'd been working overseas for Shell in their LNG projects in Malaysia. He came back, and we tapped him on the shoulder. I said, Myron, what do you think about this? And I didn't know Myron from my Shell days, but others did. And Myron took the risk. And then Myron built our entire operations group. I had little to do with that. So I got the right people in the right places and just let them go do what they were doing. But we made, it's funny, some of the decisions you make along the time. We needed to hire some operators. And the main areas we were operating were in Pembina. So we needed some of the mobile staff, and everybody's saying, you don't want to go work for a trust, though it's not a real oil and gas company. But we managed to hire 4 key operators. And the tipping point, just like with me, was the going to GLJ was a company car. We offer them the best field trucks anybody would have. Air conditioning, crew cab. They were the kings of Drayton Valley because they had the best equipment. And for us, it was logical. So your operators are spending all this time in a vehicle. There's no air conditioning, no radio other than your field radio, and it's a very utilitarian vehicle. I said, well, one of the most dangerous jobs in the oil patch is driving to and from the leases. So Myron and I decided, well, let's give them great trucks. So we managed to get our operators, and suddenly, bit by bit, people started seeing, well, this is a real company. And then one last key member, although he wasn't there at the very beginning. When you're a public company with no institutional shareholders, it's a grind. Doing your investor relations, and that was my primary role other than strategy and whatnot. And David Carey had been with Gulf, and he was their investor relations VP, or very senior. He was on the road all the time with Dick Auchinleck, who was the CEO at the time. And then when after we did the sale of Alberta's government's share of Syncrude, Gulf spun theirs out into Athabasca Oil Sands Trust, and David was the CFO. And the IR guy. And then when Canadian Oil Sands Trust bought them, we tapped David on the shoulder and said, David, we need help. We don't have a bona fide investor relations group. It's pretty ad hoc. And he came over and he turned into one of, if not the best IR person in our space for sure. He won award after award after award. But what he was able to do for us was knock on the doors of institutional investors that knew him through Gulf, say, just hear us out. Just see if there's something here that you like. And lo and behold, we ended up slowly penetrating the institutional market. So, there's 5 key people that built ARC Resources. I was the figurehead, but they were doing all the heavy lifting. And Mac and I were kind of, okay, where do we go next? Should we grow? How do we grow? It was a strange time when we completed our IPO, RBC said to us, this is the last royalty trust IPO this industry will see. It was that hard. 96. Well, they were really wrong about that because the market completely opened up and it was all retail. But, our investor base was predominantly seniors, retirement, needing income.
Yeah.
And it's a very humbling thing to realize.
Mom and pop.
Yeah, that these are not big institutions that can afford to win or lose their investments. This is important to them. So it really, and our AGMs were fabulous because you see the same people all the time. They were all the same gray-haired people that loved coming for the tea and coffee and sandwiches that we served. But it grounded us pretty good that what we were doing mattered. It was important. And yeah, we thought it was important being part of the oil. But, these were people that if we failed, it'd be very painful for them. When you have retail investors, it's hilarious. I got 2 letters that I received over the course of probably the first 5 or 6 years. The first one was addressed to the world's greatest CEO, and inside was a handwritten letter from a senior citizen investor heaping accolades on me for all the great work we were doing to help him in his retirement. Wasn't long after that, I got a letter addressed to me, and it started, "You must be the dumbest person on the planet." We had hedged oil at 75 and oil was at 120. There can't possibly be anybody dumber than you running a company. And I kept both those letters because this mattered to these people, right? One day you're the greatest, the next day you're a bum. Neither were true.
Somewhere in the middle.
It always stuck with me. And I showed the others these letters. I said, this is why this matters.
Do you remember what you priced the original equity offering?
$10. So we were, it was going to be a 10% yield. 10 cents a month was our dividend. And the IPO was $10. We probably sagged down to 6 in the early couple of years. And then we made some pretty strategic acquisitions. I'll never forget. So Prime West had a trust then, and there were a couple of other trusts. An oil patch veteran by the name of Lamont Tolley, had sponsored two. Orion and Starcore were two energy trusts, and they were collectively about the size of ARC Energy Trust. And I didn't know Monty. And Christmas Eve, probably 1998, might have been 1999, I can't remember which year, I got a call from Monty. John, this is Monty. Can you come down to my office? I said, it's Christmas Eve. He said, I need you down to my office. Okay. Drove down, and they'd been in discussions with Prime West. And Prime West guaranteed them they wouldn't go hostile, and then they did. So they asked us if we would look at the assets and see if we could compete. And over the course of the next number of weeks, we made an offer. It got topped. We made another offer, and we ended up with the assets. And it helped. The assets we got were good. We got some really good assets in southeast Saskatchewan, but it gave us more mass for us to look at other things. And so M&A was what we were doing. And it was a couple of years later, CIBC was running I got to back up. The oil patch is full of really strange stories, and this is one of the strangest of all. An accountant, I can't remember his name, in Edmonton, Suncor was selling all their conventional assets. They're going to focus just on the oil sands. And somehow, this non-oil patch financial guy had got an exclusive deal to buy, I think it was $180 million worth of properties from Suncor. They approached ARC Financial. Will you open investment? That's not what we do. Why don't you go talk to ARC Resources, ARC Energy Trust? So we sent him my way. I said, Doug, what do you think? And he came back to me. He said, this is a steal. This is outstanding. So we ended up making we said, we're not going to fund somebody else to run these, but these assets are very attractive. They're very, they were a bargain, let's put it that way.
What year was this?
This would have been 2001 or 2, something like that. But the reason I tell that story is one of the assets that came with that is called Andy Creek Montney. That's when ARC got involved in the Montney. And we should have never had those assets. Had accountant from Edmonton and he approached another oil and gas guy. They approached ARC Financial. ARC says, no, talk to John. And we managed to convince Suncor to let us step into those shoes, and we gave a finder's fee to the guys. But the key asset, and this is, again, the resource play, and Doug Bonner, I give him all the credit in the world. He looked at Annie Creek and he said, there's a lot of potential here. Don't know whether we can find it all, but there's a lot of potential here. So we started drilling Montney. 2 years later, Star Oil and Gas comes up for sale. Private company, owned by 3 or 4 lawyers in Virginia. The CIBC was running the process, and one of the key assets, the key asset was Dawson Montney gas field in northeast BC. Fit every one of our criteria. Big in-place resource. Time and technology would be your best friend. So we looked at it and we said, we need to own these assets. And I remember the team, I think the numbers were, I think we came up with a number of $690 million to buy it, which we couldn't have done had we not done these other transactions. And the team was there. That was going to be the number. And I looked at him and I said, you know what? I don't think that'll get it done. We need a 7 handle on this. Let's submit 710. And so we then had an interesting conversation with the team. They said, well, our models don't support that. And I said, well, it's only like 3-4% more, and we're not that smart. So we bumped the bid. We got the assets. And Art Corpatch, who was a CIBC guy running the process, he said, you guys were the only ones that really saw the value in the Montney. So suddenly we now have this Montney play. And the only other player in there was Encana at the time. And it's still early stages. And our investment thesis was so incredibly simplistic. We thought that Dawson had 1 trillion cubic feet of gas in it. We were paying for a 7% recovery factor. Surely we can do better than 7%.
Yeah.
We get it to 10, we increase reserves 40%. We get it to 15, we double our reserves. Well, those lands, and Myron would have a better handle on this number than I, but it wasn't 1 TCF, it was probably 10.
At least.
And the recovery factor wasn't 7, it's 50 or 60. So, but we're drilling $2.5 million wells. We've never drilled a well over $1 million in our lives, and we're getting less than 1 million cubic feet a day, marginally economic, but worth pursuing. So would have been 2005. Myron came to me with one of our drilling engineers, and he said, "We've got a proposition for you. We want to drill a horizontal well into the Montney." And Myron probably told this story. And I said, "Okay, well, tell me more." "Well, it's going to be a $7.5 million well."
Mm-hmm.
So, "Well, that's not what we do." He said, "Yeah, but we think we can get 4 times the production rate for 3 times the cost. If that works, we will transform the asset that we own." Mm-hmm. And they were wrong. We got 10 times the production for 3 times the cost. Wow. So we drilled our first horizontal well. Little old ARC Energy Trust. We were still a trust at the time. ARC Energy Trust, surrounded by Encana, Shell, everybody around us. Mike Rose's second company, Duvernay, was chasing the Doig, I think it was, just to the west of us. Progress, my buddies, Dave Johnson and Mike Culbert, they were chasing the halfway trend all the way up northeast BC, and we're chasing the Montney. Mm-hmm. We drilled a horizontal well. Holy crap, it worked. Can we duplicate it? We ended up drilling 4. Every one of them worked in a big way. So now we're going, okay, now what do we do with this knowledge? Because obviously there were confidential results for a while. Then we did something we'd never done in our life. We posted land into a land sale to buy more Montney. And then we bought more Montney. And then we bought more Montney. Mm-hmm. If you look at ARC Resources today, they're a Montney behemoth.
Yep.
And it all came from the same fundamental belief: big in-place resource assets that surely to God we can get a little bit more out of this over time. And, you know, obviously the way horizontal drilling evolved, you know, that wasn't us doing it. That was the service providers. Mm-hmm. And now it's one of the most magnificent resources on the planet. Yeah. And I'll always remember this. TD would have a Stampede conference every year. So I presented at the conference, and right after me was Mike Rose. Mike probably won't remember this. And Duvernay was a Doig player, but on all their lands, they had all this Montney land, and it was just to the west of us. And we had bought a bunch more land in the area at a land sale. And they had yet to drill their first Montney well. I think the conference was a Thursday, and on Monday it was announced Shell bought Duvernay for multiple billions of dollars to get the Montney. Yeah. And they hadn't drilled a well yet. And then Mike obviously took that and turned it into tourmaline and topaz and legendary stuff. But it was the opportunities. And then, like I said, Dave Johnson and Mike Culbert, who were the 2 key guys at Progress, good friends. And they ended up looking at all their lands that they bought for the halfway. Yeah. It was Montney everywhere. So First Energy had a conference in New York every February. So we're at the conference in New York, and I get up and present, and I'm talking about all the wells we've drilled and the horizontal wells and the land we own. It's all great. And I go and sit down, and I'm sitting next to Dave, and Mike Culbert's up doing the presentation. And he said, "We have 7,000 drilling locations." I looked over at Dave. I said, "Dave, you don't have 7,000 drilling. You can't have that many." He said, "We haven't drilled a bad well yet," he said. And so you do the math. And They probably did end up with 7,000 drilling. None of us saw the scope that the Montney would become. But fortunately, we were in on the ground floor, got in early, got some of the great lands, had a long-term vision. And that's the other thing that Mac really embedded in us was we're not making decisions for the next quarter or the next year. We're making long-term investment decisions. And where companies would go wrong was they're very worried about their share price. What can I do to adjust the price? And I've every board I've been on has had a CEO transition, and I've helped mentor them. And the one thing I said to him, and this is an absolute correct fact, I never, ever looked at what our stock price was because it was irrelevant to the decision-making that I was making. If we were going to raise capital to buy an asset, or if we're going to raise capital to do an M&A transaction, I better know what the price is. But on a day-to-day basis, it wasn't important because the decisions we're making with the drill bit, with production, that's going to influence the price of the stock more than me turning around and saying, well, we got to drill 10 more wells here because we're missing our production target. But the reason I bring that story up is John Miller, I think was his name, and I apologize if I don't get his name. I'm pretty sure it was John Miller. He was the geologist for Star. An interesting anecdote. This is what it was like back in the day. There was a headline in the Calgary Sun business. They didn't really have a business section, so I don't know where it was. It might have even been, it wasn't on the front page. It was a key thing. The sign said, "John of ARC buys Star." I'm going, are you kidding me? But that's when we bought Star. And John came to us and he said, I think the best Montney is way over here. It was miles from nowhere. Talisman had an operation there at Farrell Creek. It wasn't turning out well. They were too close to the faults, too close to the fractures. But John said, no, this is where we need to go. And it was miles from infrastructure. So we bought an enormous amount of land, probably in 2009-ish, somewhere in there. Well, that project just came on stream last year. Wow. And ARC Reserve, and they think it's 300 million a day, but it was literally, okay, we're going to buy it, and we will wait until there's enough development that we can actually have a pipeline into the area. So the long-term thought process we had served us really well at ARC. And I wish I could take credit for that, but that was Mac just saying, you know, we're here for the long term. Our mantra was long-term risk managed value creation. Mm-hmm. Our job was not, and I tell CEOs this all the time. I said, your job is not to grow. Your job is to create value. And if you're growing and not creating value, which the industry was doing, then you shouldn't be doing it. And if you're not doing it, you better be dividending the money out to the investors. And that's exactly where the industry morphed to. And I'd be remiss if we didn't talk about the Halloween massacre.
Yeah. So maybe for the listener, what was the Halloween massacre?
So Stephen Harper had just become the prime minister. He campaigned on, going to leave the trust sector alone. It's all good. And looked like he was going to be true to his word. And then it started going beyond just REITs were around forever. Real estate investment trusts have been around forever.
Still are.
Pengrowth, Enerplus had been around for a decade plus. And we felt we belonged in the category of the REITs. But then Bell and TELUS, I think it was Bell, and they were talking about converting into trusts. And the belief that people had was trusts destroy value. They defer tax revenue because the dividends go out. You're basically tax-free, and then people will, as you pay the dividends, you'll pay the tax. So the argument was there's going to be this huge sucking noise of all the tax dollars that the government's going to lose. And then the CEO of Encana at the time, I won't mention his name, went to Ottawa late October 2007, I think it was. I think it was 7. Might have been 6. At my age, I don't remember those days very much. And basically said, and Canada's going to turn into a trust. You can't let this happen. And the next day, we got the Halloween massacre. Now, is there a direct link between those two? I firmly believe there is, and I have that on good notice. But Stephen Harper went back on his beliefs. So then, and I'll never forget it, it's Halloween. So I got to get home, got to take my kids out trick-or-treating. I'm sitting in our conference room with Gordon Tate, who was the analyst for BMO and Nesbitt Burns at the time, and probably the best trust analyst. And this is back in the day of BlackBerries. We didn't have iPhones yet. And his BlackBerry keeps vibrating. And he's ignoring it. Keeps vibrating. He says, John, I got to take this call. They wouldn't be bugging me. If I takes a call, he hangs up, and he said, they've just eliminated the trust sector. They're putting whatever the tax was on, and 35% of our market cap disappeared the next morning. And it was harsh. I mean, and so here are things completely out of your control, and now you got to deal with them. And I admire Stephen Harper a lot for a lot he's done, but that was a mistake. So three of us CEOs, Sue Riddell Rose from Perpetual, myself, and Bill Andrews from Prime West. We represent the oil and gas sector. Or the trust sector. We're going to go to Ottawa. We're going to have a conversation with Flaherty about, we need to have you rethink this. Mm-hmm. We're not going to opine on Bell or any other industries, but just oil and gas. We've been around a while. We're like the REITs. You exempted the REITs, by the way. Surely you can exempt the royalty trust. And we as a group of companies, trusts, as individuals, we went to Ottawa. Jim Flaherty was very gracious with his time. We sat across the table from him, and we made our case. And by this time, I could say, that notion that we destroy value, I said, look what's going on in the Montney right now. That was a royalty trust that drove that. This narrative you've got was false. So I think our meeting was scheduled for an hour. At an hour, his assistant came in and said, you got to go. He said, no. He gave us a little extra time. I think we were there an hour and 45 minutes. And there was a senior member of the Department of Finance there. And we're making compelling case, and he keeps asking his guy from finance, is this true? Yeah. So at the end of it, the minister was very upfront with us, and he said, you make a very compelling case. He didn't say the words, but the implication was if I knew then what I knew now, maybe we'd have a different view, but you realize we can't change our mind.
Wow.
And why was that? Well, they had campaigned on Paul Martin. They called him Mr. Dithers. You may not remember that.
I remember Paul Martin. But
yeah, Paul Martin. And so they made a decision that was informed, and they made, I would say, probably a reasonable decision for the information they had, but they didn't have all the information. Mm-hmm. Whereas in business, you turn around and you course correct and say, I got better information, there's a better way. But literally they said, sorry, it's done, can't exempt the royalty trust. So our model was done. Yeah. We had 4 years to convert. The reality is it really didn't affect us other than the market cap hit. Yep. It didn't change what we were doing. We were already operating as a very, very efficient oil and gas company, but I will never forget the phone call I got from one of our investors. She was retired. Her husband had been a teacher for life and had saved up not a huge amount of money, but had something to keep her going. And her investment advisor put her into a bunch of royalty trusts that were all good names. And she lost 35% of her husband's life saving, and he had passed away. And she called me, and she was in tears. She just, what can I do? and my advice to her, I said, look, and basically she thought she failed her husband because she lost it. I said, stick with us. I don't know about the others, but stick with us. Our business hasn't changed. The taxability has changed, but for you being retired, you're probably going to not have to worry. And I said, just stay the course. I honestly don't know if she did or didn't, but that's what we did at ARC Resources. We just stayed the course. We didn't change anything we were doing because what we were doing was what good, strong oil and gas companies would do. And we got through it all. We thrived, in no small part due to the Montney. Yeah. But it was, there's moments in your career where you get hit with these things that you never expect, you have no control over, but now you got to deal with them. And how you deal with them will often dictate success or failure. And we just huddled the troops and said, okay, this is our new reality. What does it change for our operations? Well, it doesn't really change anything. It just changes how we, instead of distributing money tax-free and it goes as a tax on the dividend, right, will be become taxable. Well, the reality was we were drilling so many Montney wells, we weren't going to be taxable for many years. And the government actually lost tax revenue when they thought that they were going to gain tax revenue. But it was what it was. And so we just morphed into ARC Resources, morphed into the leading Montney player. And I retired in, I think, the January of 2013, the end of 2012. And I asked the board if I could stay on the board, which is very rare. Myron Stadnick was coming in as a new CEO, and the last thing you want is your old CEO on the board looking over your shoulder. Myron said, I don't have a problem with it. The board said, well, I don't have a problem with it. So I got to stay on the board for 8 more years until the transaction was done with 7 generations. Mm-hmm. In the COVID world, when those 2 companies came together and created a magnificent new company. And then the boards were coalesced, and I stepped off the board after 25 years in whatever that was, 2023 maybe, something like that.
Did anyone try to buy you along the way, like when they took out Berkeley and Duvernay?
No, I often ask the question, I said, well, but our land is better than theirs.
Mr. Mike Rose did the podcast 2 weeks ago.
Yeah, and Mike, and he knew the guys at Shell. Obviously, he came out of Shell. And Brian Gould, who is the CEO of a company I'm a chair of, a private company sponsored by ARC Financial, he did the deal. He was with Shell, and he did the deal. And he just said, we believed in the Montney, and these lands they had a little bit of land in the area, and these lands made sense. And the other big one was Progress.
Yeah, they bought yeah.
So what Progress did was they saw the magnitude of their opportunity, and they started looking for a joint venture partner that morphed into Petronas buying them. And then Esso outbidding Petronas and Petronas coming in over the top. And all those assets ended up in Petronas, and now they're part of the kind of Northwest LNG. So I'm looking around and I'm saying, but we got the best assets and you're buying everybody else. Part of it was, I think at the time, we owned a lot of other legacy assets that we were in the process of divesting. And so at the time all those deals were happening, we had a lot of other stuff, whereas these were pure plays. And it made sense. And you know what? I think it worked out best for ARC and its shareholders that we stayed the course. I think when I retired, I think the share price was $31 or $32, and I think we dividended out $19 or $20 in dividends. So our $10 investment turned into $50 stock. So I think us and CNRL over that 17-year period were the 2 top performing entities. And we're very proud of that. And that's a function of every single person at ARC, not the CEO, not the COO, not the CFO, but every single person with the ideas. We got to drill this horizontal well. We should go get these lands. And the one thing that we did, I think, better than most was our focus on talent. And the analogies to hockey teams or football teams or baseball teams is pretty simple. Whoever's got the best players will usually do better. And that was true here. I'd often say I'd rather have average assets with great people than great assets with average people. And we were able to attract some incredible talent to ARC, and they still are. I'm proud of the fact that my CEO was Myron, who started with the company in 1997. And his successor is Terry Anderson, who joined our company in 1998 or 9, something like that. So we've had really good continuity, and ARC's doing a spectacular job. Terry's doing a great job at ARC right now, and we just brought on the Annie Creek project, and it's proud. There's a lot of pride in being able to build something that obviously created wealth for my family, but it created wealth for more. Yeah. It created jobs. 1,000 people work there probably. We've paid tens of billions of dollars in royalties and taxes, and that's what you could do back in those days. You and I were talking before we turned the mics on about the opportunities we had as young, idealistic, reasonably smart people to say, I got an idea. Let's go see if people will give us $200 million to do this. That was the beauty of back then. It's a different world now. I don't know if we could do it, if it would be successful today, but in the moment it was brilliant. It worked well.
It's easy to look back nowadays with hindsight. You came across the Montney, which really transitioned the company from one generation to the next and had the resource for you. But what do you think you would have done without the Montney? Did you have a plan?
We'd still been a great company, but the upside, like there's nothing compares to unlocking a world-class resource play. And just the ability, like when we were drilling shallow gas wells, sure, they only cost $75,000 each, but we'd have to drill 100 of them to match one Montney well. Yeah. So we'd have kept plugging away. Pembina was a great property for us forever, but once we got the Montney, Pembina was more valuable to other people. And over time, we slimmed down to essentially being a Montney and Duvernay player because Seven Gens brought some Duvernay assets as well. And it was quite a bit of right place, right time, but it was also recognizing something when others didn't. Probably the best decision I ever made, other than hiring Steve, Doug, Myron, Susan, and David, was when I went into the team and said, we got to bump our bid for Star. Because if we didn't get Star, we wouldn't have gone into the Montney, and ARC would be a completely different company right now. We just still found ways, but if you're entering a big play late, like we got in so early, we had way more land than most people. And then drilling technology just unlocked assets that we were convinced would never be economic. The tight lower Montney, dry gas. Yeah. And yet, I mean, I tell my friends, so I spend the winters in California and got a lot of friends from all over the U.S. They know nothing about the oil and gas sector. And I said, if I told you we could drill a mile down and 3 miles out and put our bit in the middle of a room this size, you'd tell me I'm crazy, right? Yeah. But that's what you can do. Yeah. That technology did not exist 20 years ago. And it just keeps getting better and better. And that's why there's more longevity to the oil and gas sector, certainly in the U.S. and Canada. The challenge with Canada, for Canada, is we've got way more resources than we have capital to exploit them. And of course, we've got regulations that impair exploitation of the assets. But we often wonder, the big plays in the U.S., big time, really fabulous plays, but they got drilled up in a hurry. And we're drilled up to a fraction of the drilling intensity. And I chaired in my post-ARC career, I chaired a board in, it was Plano, Texas, CO2 EOR company. We said, well, why aren't more U.S. companies looking in Canada? They said they cannot understand the regulatory regime, and it changes so abruptly. The risk premium isn't worth it. We got great things to do ourselves down here. But I think the tides are turning. They're into the creaming curve is at the point there where their big plays are now into still good quality stuff, but the Montney is I think, and the Duvernay, quite frankly, the Duvernay is a remarkable asset as well. And I was on the board of Varen Crescent Point, which became Varen, and they were able to convert from one world into the Duvernay, and that's where I learned a lot about the Duvernay. But between the Duvernay and the Montney, world-class assets. We should be feeding Asia all the LNG they can possibly take off our west coast, and yet we've got regulatory environments that don't allow it. It's sad.
Yeah. Is it a challenge developing a resource play and maintaining your capital discipline, paying out shareholders?
No, because there were moments where, and a lot of what we do is, quite frankly, serendipitous. I'd call it blind luck, but I'll give ourselves a little more credit. It's serendipitous. So I'll never forget. We posted some land just west of Dawson, and we're now competing with Shell because I think they already bought Duvernay from Mike, and our geologists had identified which lands they thought were most prospective, and we had some lands in the area. So we said, well, geez, we should probably drill a well into the land sale. So I said, Myron, we got to get a well drilled. And so we drilled it at a spot that had the easiest access. And we drilled it because it was convenient to drill right there. We knew the resource was there, but it's not uniform. And it was, at that point, the best well we'd ever drilled. And we had the information going to the land sale that others didn't. And that was serendipitous. I mean, that location wasn't pegged by months and months of careful geologic analysis. It was, we're going to get a well drilled in the next 6 weeks. And but that's what the oil and gas industry is about, right? You have your hits, you have your misses. But the beautiful thing about the Montney is you always know you're going to get hydrocarbons. It's just how economic. So it took some of the, not all, but some of the risk out of it. And when you're using new technologies, there's also new risk. But I feel, when I look back on my career, having signed the AFE for the very first horizontal well drilled in the Montney in Canada, that's something I'm pretty pleased about.
Yeah. Not
that I had anything to do with it. It was a drilling engineer that said we should do it, but I got to sign my name to the AFE.
But those wells were expensive. And you also
you had to take a deep breath.
And you had to pay a dividend, and you had to...
Yeah, but it was, by then we had the problem with the royalty trust model as it existed before ARC was it was 100% payout.
Yeah.
You can't run a business that way.
Yeah, it's hard.
We started... when we did our IPO, it was a 90% payout because we didn't have that much sustaining capital. But over time, we morphed it to about a 50% payout. So now it's not unlike most oil and gas companies. There may be a little bit of growth, but basically most companies, if you can sustain yourself for 50% of your cash flow and dividend or buy back stock, I mean, you look at some of the share buybacks going at companies like CNRL, Duvernay or Tourmaline. Tourmaline is a big dividend model, so there's two different ways to do it. But we've morphed into a much more sustainable business model, and that's what we had already morphed to by the time the trusts were banished in Canada. We already had the lowest payout ratio. We already had the lowest debt in the industry, and it was a very conservative way to run the business. And when I mentor CEOs, I mention this. Well, I can't think of a single quarter and I'll just talk about the 17 years that I led the company because I didn't follow it that much. I followed it, but not to the same extent. Not once were we the best performing stock in a quarter. Not once. When times were really, really good, we were probably middle of the pack.
Yep.
High prices. When prices were lower, we were top quartile, but we were never the highest return stock in that quarter. And yet, over 17 years, we were the number one. We were neck and neck. And the way we did that calculation, we just assumed that all dividends were reinvested through the DRIP program. So the compound annual return was order of magnitude 20% over 17 years. And that's because of the way the company was structured, the assets we had. There was luck, serendipity, good fortune, whatever you want to call it, involved. But there were some really, really good decisions made by some really, really competent people to get us there.
So 50% was your rule of thumb on the payout.
Yeah, it'll vary. Some companies can sustain their business with a little less. Some takes a little bit more. But it's basically, how do you stand still? And then can I create more value by drilling some more wells or paying a dividend? And dividends are valued. The other advantage we had in the Montney, and I would talk about this all the time to investors. I'd go into them and say, this is why the royalty trust model is superior to the traditional E&P model. At the beginning of the year, we all set our budgets. We pick an oil price. Oil price is going to be $80. We look at our suite of opportunities. We obviously do the best ones first. And we get to the point where, okay, we got to spend 50% of our cash flow.
Yeah.
And we're going to give the rest away. Well, if I'm an E&P company, I'm going all the way down the list, spending all my cash flow. Now, guess what? Oil's not 80, it's 100. I get all this extra cash flow. Where am I going to spend it? at the lower end of the return schedule. So the capital discipline by not reinvesting all the cash flow, which was the standard business model for oil and gas companies. But every analyst will tell you that over the course of 20 or 30 years, the industry as a whole would generally produce de minimis returns. There'd be periods where you can make or lose a lot of money.
Right.
But over time, there wasn't an overwhelming amount of value creation other than certain companies, the Tourmalines of the world and the ARCs of the world were doing it, but others weren't. But it there was a better way, and that's where the industry is today. And it's now okay. And the flip side to when you spend all your cash flow when times are good, you're bringing on way too much production. And for every quarter you get of really good prices, you're going to get 4 quarters of crappy prices because prices always fall and stay low faster and longer than going high and staying high. And so the post-COVID, the investors kind of drew the line and said, okay, we're done with this. You just keep bringing on all this extra production and driving price down. I need a return.
Right.
So that's why share buybacks and dividends are now an integral part of virtually every company's business model. And not necessarily share buybacks, but dividends was our model from day one since 1996. Because it's a more sustainable model. It's a lot easier to run a business where you only have to replace. Like the thing about resource plays, are great, but the average decline rate is high. And what we did at ARC Resources, and we had the benefit of being a trust because we didn't have to grow. We managed our decline rate. You could go out and drill a bunch of Montney wells that decline 50, 60% in the first year, but the treadmill you're on, spending capital to sustain the business, is fast. And if there's any hiccup in cash flow, you can't do it. Whereas we were drilling at a much slower pace, so I don't think our decline rate ever got above 27 or 28%, which is still high because when we started it was 10 or 12.
Right.
But an important part of our business strategy was not drilling the Montney so fast that it put us on this treadmill of 35, 40% first-year decline. And I think the whole industry has now learned that lesson. And we're more disciplined as an industry. We're more profitable as an industry. And we're way more sustainable as an industry than we were pre-COVID.
How'd you view hedging? Did you take a mechanical sort of index approach, or did you
Hedging is the
do your best?
the most difficult, controversial part. We were absolutely, so I used the terms before, long-term risk managed value creation. Well, if you're going to manage risk, you're going to hedge. It's how much do you hedge, when do you hedge, how do you hedge? That's the magic. And there are proponents, even some of my partners today at ARC Financial, believe you need just a rigorous, you should always be X% hedged out 12 months, 18 months. At ARC, our view was we got to put a little more science into that than just
Mechanical.
And David Carey, who I mentioned earlier, he'd always ask us when we're having a management meeting, we're talking about hedging. He'd look at us, he said, are we hedging or are we speculating on price? Mm-hmm. So our approach to hedges was if we can find a price that satisfies our business model, lock it in, and we'd lock up to 50% in. We'd never go more than 50% unless we had some belief. And a couple of times we did where the research side of ARC Financial was telling us, there's weakness ahead. We might move up a little bit. But then what I would, and I'd have talked to other CEOs and they hated hedge losses. They just despise them. And the letter I told you that I got, you must be the dumbest CEO on the planet because look at all the money you're losing in your hedges. I said, this is what you don't understand. This is what I tell investors. If you're hedging to support your business model, then the best possible outcome you have is big hedge losses. If you have big hedge gains, it means that the half of your business that isn't hedged is in the dumpster. If you got big hedge losses, the 50% you've hedged is doing very well. It's meeting all the criteria you had for investing your money. And the unhedged 50% is doing very well. So it's counterintuitive, but I would argue that if you're hedging for the right reasons with a disciplined approach that supports your business plan, hedge losses are vastly superior to hedge gains. Because hedge gains means your unhedged portion is not doing very well and you're making a bunch of money off that's not sustainable. When the hedges roll off, you're back down. So we were never concerned about whether or not we were going to be making or the problem with hedges and the reason earnings didn't make much sense in the oil and gas sector is you'd mark to market those every quarter. And if you had $200 million in hedge losses, it'd all go into a single quarter. Yeah. And then they reverse and then it all goes, so your earnings just go up and down sawtooth. And you could never really get a good picture of the health of the company from earnings. But hedging is... Our belief, too, was the more debt we carried, the more hedging we should do. Yeah. The less debt we carried, the more open we could afford to be. And we ran a very conservative balance sheet so that, our target was 1 times debt to cash flow, whereas the industry was running 2 to 3. Yep. But at 1, if prices ran up and they were pretty high, you'd be at 0.5. Well, that's a pretty good place. But if prices went the other way, you're at 2 times debt to cash flow, whereas the guys that were 2 are now at 4 or 5 times debt to cash flow. They're too much debt, and now most of the cash flows paying down or paying off debt. Or you just get into a situation where it's unsustainable. So that was a great lesson that Mac taught me. I tell this story, I think it was probably within a year of starting ARC Energy Trust. Mac walked into my office one day and he put a book on the table. He says, "You need to read this." Well, okay. The book was When Genius Failed, The Rise and Fall of Long-Term Capital. Yeah. It's a great book about a hedge fund that had great discipline until they didn't. Right. And when they decided that they were smarter than the market, and they didn't now, because their whole game was making a few pennies on a trade and always be covered, and you'd never be exposed. And when they got away from it, and it was currency trading that they did in South American countries that took them down. But these were all Nobel laureate, brilliant people.
Yeah.
And so I've asked Mac many times, he'd never answer this question. I said, what are the lessons you wanted me to learn from that book? I could say, well, you're not as smart as you think you are. So yeah, okay, that was probably a lesson. Debt is your enemy. Discipline, if you lose your discipline, you're exposing yourself to risks. But I think more importantly, and one of the things that ARC Resources, ARC Financial did and still does today, I think as good as anyone, is we knew we were in a relationship business. We have a relationship with our investors. We have a relationship with our banks. We've got a relationship with our underwriters. If you read When Genius Failed, every bank in the world wanted to do business with long-term capital because they borrowed a lot and they treated their bankers like servants. When the shoe was on the other foot, guess what happened?
Yeah.
The banks weren't that willing to work with them. If you're running your business as a relationship-based business, when the times are good, the times are bad, if you've got a strong relationship with your key stakeholders, you'll come out of it a lot better. And there are companies in the oil patch that over time, win-win wasn't good enough. There had to be, if I win, you must lose. And there was that kind of atmosphere for some companies. Our view always was, I don't care if you win, as long as we're doing well and we win. So that was another message in that book that to reinforce what we were doing anyways. We're in a relationship business, and you have to nurture that relationship. You got to manage it. It's a relationship with your staff, your government, your investors, your banks, everyone. And when times are good, you enjoy it together. When times are bad, we would always be, we knew that if the banks started calling loans, we'd be the last call that they would make. Because A, we weren't over-levered, and B, we had a very strong relationship. So that's part of managing the risk of a business, whether it's hedging, balance sheet, and not chasing quick returns. I wish I could take credit for that, but that was Mac, and he taught me a lot about what it takes to run a business, because I knew nothing about it when we started.
So when the original Montney wells started to come on, the gas volumes were huge. Did you think to yourself that we needed to get involved in the infrastructure and start to own everything? And that very important.
We always believed we should own our own infrastructure.
So for the listener, why is that?
In the U.S. model, selling your infrastructure to raise capital to do stuff, it makes sense. But the problem you have, as we saw it, and I'm not saying you should own 100% of your infrastructure, but we believed we should, because let's say the price of gas is $3. And to operate your facility, it's 25, 30 cents. But if you sell it to a midstreamer, you're probably paying $1 an MCF in processing fees. Well, the price of gas drops from 3 to 2. Now you got $1 margin instead of $1.75. It drops to 3 to 1, and you got zero. Whereas if you own your own infrastructure, you still got 50 or 60 cents of income
Margin.
So it's a way of managing risk in the balance sheet. Having said that, companies have done very well by moving their infrastructure. And what would compel someone to sell their infrastructure to a third party? Well, the key reason was their cost of capital was lower, so they could pay you more than it was worth to you, because their cost of capital as a more stable business, if you think of Kiera or companies like that, Topaz.
Competitive advantage.
They've got a lower cost of capital, so it's worth more to them. Whereas we can take that capital and invest in 30, like we wouldn't invest in a Montney drill that didn't have at least 100% rate of return. In a down market, maybe you go down to 60. Whereas infrastructure investments, if you're making a 10 to 15% return, you got a very solid business. So you could take dollars that you could turn into a higher return by selling it. The problem is you can do that once, then you don't own your infrastructure, and then you're up and down with the market. So it's not to say that it's the right thing for everybody, but for ARC and the way we wanted to have more direct control over our business, it made sense. Now, if we were drilling into a new area and there was a gas plant with surplus capacity close by and we could get the gas in there sooner than building our own, we would do that. But, I mentioned Andy Creek earlier. I mean, they spent a lot of money building huge gas plants. And that's money they could have used for other purposes, but it was the right thing to do for the business model that we had and ARC continues to have. It just, in the simplest form, as an owner of anything, you want to have as much control over what you own as possible. Mm-hmm. And if there's parts of it that you don't have control over in adverse markets, it can be a challenge. So it's beauty in the eye of the beholder to some extent. The U.S., the model was don't own your infrastructure. Canada, it's been more of a model of own it. And now it's a blend.
Did you worry there was too much gas coming into the basin?
Absolutely. And that's the problem. Suddenly you're drilling these 20 million a day gas wells, 100 million a day gas wells. So the biggest challenge Canada has, got this massive resource. We have a captive consumer in the U.S., or buyer. We're captive to the U.S. buyer. So they can buy our gas for AECO 50, 75 cents and sell it for $3.50 down south. So what you had to try to do, much harder to do than you might think, you've got to diversify your market. And that's one thing ARC started doing early. We had to find a way to get access to the prices outside of AECO, which is the benchmark price in Alberta. So you'd have to invest, and now you're signing up for long-term transportation in a pipe. And if suddenly your wells don't produce the gas, can you meet that obligation? So that it's always managing the risk of, do I take on too big a obligation? But the benefit of it is I can now get Chicago pricing instead of AECO pricing. Mm-hmm. But it's a real problem. And what really hurt the gas price in North America and Canada in particular is all the solution gas that was coming. Everybody's drilling for liquids-rich gas or oil with gas. Gas was a byproduct. All the money was in liquids. So even in the Montney, we'd start drilling the more liquids-rich part of the play because the gas really wasn't worth much. Unless you had a whole bunch of LNG projects on the West Coast, and then it would have created tremendous value for Canada, the provinces, the federal government in taxes and income, and yet we refuse to embrace the resource. And thank goodness we have our first real LNG project underway, the Canada Northwest LNG. Or LNG Canada, I guess it's called. I can't remember which one's which. Mm-hmm. And it's still ramping up, but it'll be 2 BCF a day by the second quarter, I think, maybe first quarter. That's a big deal. That's going to help a lot. But we need more of those because we've got the ability to produce way more gas than we can sell. And, even on the oil side, I mean, it's just nuts what we've been forced to do as an industry because we should be supplying oil to Eastern Canada. They're buying oil from Venezuela or somewhere else, and we're selling out our oil, better product at a discount in the U.S. They turn around and export the products. We get a discount of $15, $20. We should have Energy East should have happened. Yeah. But one province wouldn't support it, so suddenly it doesn't happen. So we as an industry, we have to find a way to diversify our markets. But the only way you can do that is to get to Tidewater, and here we have a federal government with a tanker ban on the West Coast for oil tankers, and we just can't get enough. There's some small LNG projects coming, but, Prime Minister Carney has this new large project. I can't remember what it's called. The Large Projects Office here to look at projects that are in the national interest, like the railway was, like the Trans-Canada Highway was, like the Trans-Canada Pipeline was. Included in that list should be LNG projects, and yet they're nowhere to be found because they still don't support fossil fuel development. And that's a shame. I often reflect on just how much value we're giving up by selling our products at a discount, and it's shameful.
Yeah.
That could be creating wealth for future generations. It could give us better social programs.
Yeah.
Take care of the needy in our population.
Yeah.
Instead, we don't have the advantage of any of it. And Premier Smith, I think, is thinking about it the right way. If we can get a good deal with the federal government, let's do it. If we can't, we got to start looking after ourselves. Whatever that means, whatever that looks like. But we have to start controlling our own destiny in this province so that I'm okay. My kids are going to be okay, but my grandkids, I've got 11 grandkids. What are we leaving them?
Yeah.
And if we don't leave them the kinds of opportunities we had, shame on us.
All right. Before we get into more current events, so the four lawyers from Edmonton, you paid those guys $700 million.
They were from Virginia. Yeah, $710 million.
Did those guys split it 4 ways?
It was interesting. We said, why are you selling this asset now? He said, they're all retiring.
It's pretty good money.
Family planning. And they had just started investing with Star. And Star created a tremendous amount of value for them. Mm-hmm. Yeah, so that was a privately owned company with probably 90% of the stock owned by these 4 lawyers in Virginia and the rest by management.
Wow.
Yeah. But those are the kinds of things that you could do. You know, if you put money to work and Star did a really good job. Their business model was quite similar to ours, and that's why it worked so well for us. But they're the ones that Star was even a smaller company than ARC was. They're the ones that were really drilling up the Montney more than anyone else, but it was all vertical, all marginal. So yeah, there's the tremendous wealth has been created in this industry and tremendous wealth lost.
Do you keep up with those guys? I mean, the time value of money, they're probably
they were
billionaires by now.
We never really we met their lawyers obviously because we dealt with it, but I got some of the insights from the guys at CIBC that had hired them. But yeah, but that's what the industry was. You know, people would invest in the opportunities that we had out here. They're not doing that now because there's too many too much regulatory uncertainty, and unfortunately, both in oil and gas and the power sector, which is where I'm quite involved right now as well.
Before we get to that, there was one question from Twitter/X, if that's okay.
You bet.
Guy, a good fellow from X, he asked good questions. His name is Energy Investor. Does the current slate of LNG and egress expansion plans, are they enough to keep the WCS differentials to natural gas tight?
No.
What was your thoughts on that?
No, we need more. It's helpful. Data centers in Alberta will be helpful, and data centers will come to Alberta. But right now, we need that. It will be helpful in the sense that the majority of companies obviously aren't going to be exporting gas through the LNG project. But that's a 2 BCF a day project right now that could become 4, probably will over the next decade as they expand the facility. Well, you take that 2 BCF out when we're producing whatever we are, 14 or 50. I don't even know how much we produce right now. At the margin, it's going to matter. But we still have that egress problem. And you look at what the U.S. did in the last 5 years compared to what Canada did.
Yeah.
So what's the U.S. doing? Building all these LNG import terminals because we're going to be short of natural gas. Suddenly, we're long gas. And in a heartbeat, they turn them into LNG export facilities. And they're buying our gas at a discount and selling their gas at a huge premium. costing every Canadian, every Albertan, every Calgarian huge amount of money. So yes, LNG projects will help. We're actually quite bullish on the medium term for natural gas. Now, that doesn't mean it used to be where $3 was the price you really needed to have a good business, and you'd hope for $5. Now, $1 is a mediocre business, but you can survive. But if you're in the $2.50 to $3 range, you got a very, very robust business. Yeah. So as LNG Canada ramps up and gets to the full 2 BCF a day, that gas is in the market now. So that's going to ease up, make room for more gas in other parts of Northeast BC and Alberta. When data centers come, they'll be natural gas power generation driven, and that'll add several hundred BCF a day of demand. So incrementally, it'll all help. It's just we have to make sure that we don't drill it up too fast and we recreate the same problems that we just spent 5 years getting rid of. So we at ARC Financial actually see a pretty attractive near-term future for natural gas, not the next quarter. You know, the reality is you're always beholden to the weather. If you had a really good cold snap early in the winter, you'd have good gas prices all winter. If the cold snap came in February, you had terrible prices. If you had really hot weather in the summer, you could get good gas prices. The more stable demand for data centers or LNG you have, it takes the volatility out of it, because now it's not, gee, it's hot today, so therefore I got a good gas price for air conditioning load, or I got a good gas price because it's 40 below outside, the wind isn't blowing, and natural gas is supplying all the power in Alberta.
All right, some current events.
Yeah.
Nowadays, like we mentioned, you're the chairman of TransAlta.
Yeah.
How come you got involved with TransAlta?
As I said to you earlier, I can use 100 words to answer a question that can be done in 10. I'll go back a little ways. When we set up ARC Resources, we needed directors, credible directors, because we're trying to sell this to the market. And our initial directors were John Bedham, who'd been the president of Dome Petroleum, Walt DeBoney, who was senior VP with HBOG and then Dome, Fred Coles, who had been my partner at Coles Gilbert, Coles Nick Fort Pinnell. And Mac had a good friend out of the West Coast, Michael Konofsky. He said, Michael, I need you to come on my board. I don't want to come on your board. I don't need your board. I got other things I'm doing. So he finally relented, and he said to Mac, I'll give you 1 year. I'll come on the board for a year. And I think he retired 15 years later after signing 15 one-year contracts. And the reason I bring that up is he was on the board of TransAlta, and he was leaving the board in I believe I joined the board in 2014 or 15, and he was leaving the board. And he recommended me as a candidate. And so they approached me, and I said, well, and the one thing I knew with my board work, I didn't want to necessarily compete with ARC Resources. So I wasn't going to go on another Canadian public board, even though I eventually did go on one later. So I was looking, I got retained by a service company in Houston to be on their board. An oil company in Plano, Texas, I ended up chairing. And the TransAlta opportunity just seemed really interesting and unique, and it's been fascinating. You think the oil and gas sector is complex?
Yep.
And at TransAlta, we've lived through deregulation. We're restructuring the market, going from long-term capacity contracts to merchant. It's been a fascinating business. Never did I expect I'd be chair of the organization at any time, but about 4 years ago, they tapped me on the shoulder and said, would you? And it's been great. I learn constantly. I think I know a lot about the oil and gas industry, certainly more than I know about the power sector. I learn more about the power sector every day. And it's a fascinating business, great opportunities in Alberta. And we're right at the tip of the spear on the anti-fossil fuel conversion. We're getting off coal. We're completely off coal in Alberta. We've got one coal plant remaining in Washington State that will be shut in at the end of this year by legislative edict. But just seeing how the two industries mesh together, because natural gas is now the fuel of choice, because the reality is we have enough wind and solar, predominantly wind production in Alberta, that when the wind's blowing and temperatures are moderate, you don't need any gas-fired power production. But yet, when it's 40 below in the winter, it's always when the wind isn't blowing, and now 98% of your power is coming from fossil fuels. So how do you manage those ebbs and flows? And it's a real interesting challenge. Alberta chose to go to a merchant market, which means they're not paying for standby capacity. You're just basically selling a spot price, and Alberta's overbuilt. So it's a challenging market right now in Alberta, but fascinating.
So yeah, every year there's a redundancy problem when it gets cold. Everyone's asked to conserve power. I mean, this isn't a power podcast, but why is that?
Well,
how do we fix that?
So the problem we have is that, and it's throughout North America, the grid hasn't kept up with demand. To get new transmission lines built in the U.S. takes probably 15 years. In Canada, it's probably close to that. Nobody wants power lines anywhere near them. So you don't have power in the right spots all the time. And you're building a bunch of wind farms here, but the power is needed somewhere else. And the thing about wind and solar power, it's pretty good in the local area, but you need an inertia in the grid coming from big rotating equipment, where there's nuclear-fired, gas-fired, coal-fired, whatever it is. You need that energy in the system, and basically all the other electrons hop a ride on it. So if you've got too much wind in the system, you've got power in the wrong places. And Texas went through it. South Australia went through it. Spain, Portugal went through it. They put too much wind in their system, and the grid becomes unstable when demand is too great and there's too much wind in the system. And Alberta came close to doing the same thing. Alberta's like every province in Canada. I really don't know about the Maritimes, but you've got BC Hydro, Sask Power in Saskatchewan, Manitoba Hydro, Ontario Hydro, Quebec Hydro. They're all crown corporations, and the majority of the electricity sector is controlled by the crown corporations. The only true merchant market is Alberta. So all this wind, these wind assets are pouring into Alberta, and Alberta's overbuilt with wind. We've got more than quite frankly, I think we should have. It's slowing down now. But now you've got the volatility of at times you need no gas-fired power production, even though you still need inertia in the system. And at other times you need it all. And for any politician, one of the biggest lightning rods is what's my electricity price to the consumer. So every jurisdiction is concerned about how do we keep that price as low and stable as possible. And yet we're saying you've got to have capacity on standby, because it's not our job as a public company to retain reliable backup for you and not get paid for it. So there's market redesign constantly going on, and it's an evolving thing. But Alberta in particular is unique because while we have wind farms in Ontario and Quebec and New Brunswick, it's not to the same extent we have in Alberta.
Just seems crazy that a province basically unlimited natural gas has power problems.
Yeah, we've come close during some severe cold snaps, and the price of power will ebb and flow from $40 to $2,000, $1,000 a kilowatt hour or megawatt, whatever the term is, and that kind of volatility isn't good for the consumer. So it is a natural target of regulation for governments.
Do you think public markets are valuing Canadian energy companies appropriately nowadays? And are they still misunderstood relative to the States?
I think I touched on it sooner. Yeah, we're undervalued, relatively speaking. I think we've got decent valuations, but the U.S. companies are valued at a much higher, much more significant level because we have more assets and we have capital we have to attract. So two things happened when the resource plays picked up in the U.S. They used to have to come to Canada because they didn't have a lot of viable alternatives. And then you get the big plays in the U.S. and, well, wait a minute. I can invest here in South Texas rather than Northern Alberta. I can get my product right to market. I don't have to worry about the regulatory uncertainty. So suddenly, the need to look to Canada was diminished. At the same time, Canada was bringing all this additional resource on. And now we're at the point, and we've had this conversation with other U.S. directors I know. We had a U.S. director on the Varen board, Jim Craddock, from the Houston area. And he said, for the life of me, I don't understand why more U.S. companies aren't coming up here. The Montney, the Duvernay are more profitable, more prolific, less densely drilled. And he said, the only explanation is complex regulatory framework that is subject to change without notice, that adds a level of risk. And the one thing we always say in a business, if you're going into a new jurisdiction, you better really understand it. When I was on that service company board in Houston, we're in 23 countries. It didn't make any sense. Did we truly understand? And we'd have capital traps. So entering a new jurisdiction, they look at everything. They love the resource. They love the technology, love the opportunity, but the regulatory regime scares them. So that means we will trade at a discount. Now, the valuations are still better than they have been, but these assets should be worth more. But we are where we are.
Investors focused on capital preservation, which you've been good at ARC through the years and know a thing or two about.
Yeah.
What would you suggest people looking at?
You look at the business plan and you look at how much the key things in our industry is how much capital does it keep you, do you need to stay flat? That's why the oil sands are such a spectacular investment today. Massive previous investment, the sustaining capital is relatively modest relative to the revenues, whereas in the big resource plays, we still got some pretty significant capital. So how much capital does it take to stand still as a business, which says how much free cash flow do you have?
Return on equity.
And how does that find its way back into the investor's hand? I'm actually a believer in sustainable dividends over share buybacks, but share buybacks are a big part of it. So over time, you get the same valued asset over fewer shares. It should go up. But the key thing that most investors are looking for is some income. So which are the most reliable income sources? Which have the most conservative balance sheets? Which are the ones that have the slowest treadmill that they're operating on? Would be the simplest way to describe it.
It's the fall of 2025. Are you cautiously optimistic on
I'm a
energy?
pathological optimist. I just can't help myself. Although it's been hard, looking at the regulatory hurdles we have to get our world-class resources to market. But I'm always optimistic that common sense and good sense will prevail. It won't always be in plentiful supply at any given moment. But if you look at the way the pendulum swung on renewables, it was nuts. It was crazy. It didn't make any sense. It was unsustainable. You can't get rid of fossil fuels and still run a grid. You may be able to get off fossil fuels over time, but it's not going to happen in short order. You can't force everybody to drive an electric vehicle in the next 10 years because the supply won't be there. There was so much misdirection, for lack of a better description, in the industries where they were, rather than the market saying this is what we need, it was government saying this is what you will do. Yeah. And I don't know about you, but I've never met a government that knows what's best for me better than I know what's best for me. But that pendulum has swung. I mean, if you look at ESG, and every company has to have strong environmental, social, and governance policies. You just have to have them. And we did have them. We do have them. A couple of years ago, it was if you didn't have significant emissions reductions in your business plan, I'm not going to invest in you. If you're a power producer, if you didn't have significant renewables in your portfolio, I can't invest in you. And then what do you see? You see the emergence of resource plays in oil and gas, data centers. I mean, if you take a hard look at what's happening in power demand in North America and the world, it's staggering.
Yeah.
I mean, for the last 20 years, demand has been absolutely flat. And I think it was Virginia. If you look at their power demand, the classic hockey stick, and it's data centers.
Yeah.
Because they are very, very, they need huge amount of power, reliable, stable. And so the realization that you couldn't do that with just renewables, and now returns matter more than ESG. So now you're able to say, I've got strong ESG component, but I'm a fossil fuel power producer / oil and gas company, but I'm the least emissions of any. And now investment's finding its way back. So that's my way of saying that whenever we get policies that are out of sync with reality, I'll put it that way, which is what I would argue we had in the off fossil fuels. Reality will come to bear pretty quick when you start getting blackouts, brownouts, or you have to curtail power, or suddenly you can't build a data center. And if you don't build a data center, you're allowing other jurisdictions to move forward. So the focus has become more balanced between we need strong ESG policies, but they're not going to dictate what your business plan should be, because fossil fuels, no matter what anybody chooses to tell you, will be a huge component of the energy complex for decades to come. Yeah. And there will come a time where we don't need all this oil and gas. And, you know, in peak oil theory in the U.S., that oil production peaked in the U.S. in 1970.
Yeah.
Well, fast forward 30 years, suddenly you got a resource play, and now you're up 50, 70, 100% in production. Mm-hmm. Nobody saw that coming. So now what was thought to be a scarce resource that we've got to wean ourselves so we're not totally reliant on third parties like OPEC. Now you've got a domestic resource. Doesn't make sense. And the U.S. has actually done a much better job than Canada in quietly saying, you know what, I still want us to be as green as we can be, but we're going to allow you to build all these. Like in the later stages of the Biden administration, he just capped future LNG projects, export facilities. To an industry person, it made no sense. That's gone again. So now again, North American naphtha, and the more U.S. gas we can get egress out, the more Canadian gas we need, and that's why we're cautiously optimistic about a more constructive gas price environment in the coming years.
Favorite time in your career thus far?
Favorite time? Right now. It's fascinating. It's frustrating. I've had 3 careers as I look at it. Graduated in 1977, and I was a consultant until 1994. So there's 17 years that were preparing me for what came next. It was giving me the information, the contacts, the grounding to be able to do something different. The days of building an industry, because we didn't just build ARC Resources. We and other CEOs built an entire industry of royalty trusts that were tremendously profitable. And that was very exciting and hard work. Spent a lot of time in the office away from the family. Spent a lot of time in planes. I remember the day when I received a package from Air Canada with a copy of one of their Airbuses or a model of it, and a card proclaiming me as a million miler on their system. When you consider I flew Air Canada about half the time, that's not a badge of honor. It means I've been in the air for millions of. So that was difficult. In retirement, now I've got more control over my own time. I've been able to work with ARC for a number of years. The Crescent Point, Varon, and now it's part of Whitecap was a very fascinating time. I never thought I would join another Calgary Oil and Gas Board, but they did a very unique thing. They elevated a ready in 5 years guy to CEO, Craig Brixa, fabulous guy, did a magnificent job. And they asked me if I'd join the board and help mentor him because being a CEO is different. People can have great amounts of responsibility as CFO, as chief operating officer. But at the end of the day, the old adage of there's the last throat to choke as a CEO. So the CEO is called upon to do a lot of things. And the step up is not always that easy. I was lucky because I was allowed to grow into it because I really didn't know what we were doing. We were just trying to survive. But now when you have someone step into a CEO role, it's a pretty big leap. And I've been really fortunate that whether it was the Denbury board in Texas, Tesco in Houston, the Varon board, when Craig came on, at TransAlta, John Cousineur's took over for Don Farrell. I've been able to help mentor new CEOs, and that's been very gratifying because my belief is this province, this city, this country offered us tremendous opportunities that many of us took advantage of and have done very well. And it is our duty and our responsibility to pay it back, whether it's through philanthropy, mentorship, whatever it is. There isn't a single person like me that got to where they were without somebody along the line helping to guide them. And so being able to have a lot of time off, but have a lot of meaningful time in the boardroom to help mentor people and help evolve business plans. It's been a lot of fun. To tell you the truth, when I retired, I thought I was done. I quickly realized I wasn't a good enough golfer to golf all the time. My wife didn't want me around the house all the time. I needed to do something else. So I've been very, very fortunate to be able to do the board work that I've done, and that's coming to an end. I'm 72 now, and most boards have a get the hell out of Dodge card at 75. So I don't have a lot of running room left, but it's been fascinating to still learn once you thought your main career is done. I've probably learned more in the last 12 years post-retirement. Maybe not more, but as much as I did in the previous two iterations of my career, the 19 years with ARC and 12 years getting ready for ARC. So that's why I say it's a favorite time. I've got 11 grandchildren now. I can spend a lot of time with them. And the CEOs of these companies have all the hard decisions to make. I can just try to help them make informed decisions. So we're lucky, and lucky to have health still. You just don't know what tomorrow brings.
Yeah. And with a skill like capital allocation or even sensing or knowing where to find oil, it's almost a skill that gets better through age, where a lot of the best capital allocators are better.
Yeah, and what the industry has transformed a lot. When I entered the industry, the most valuable person in the company, people in the company, were the geologists and geophysicists. Where do we go to find the resource?
Sure.
They were important in finding the Montney, the Duvernay, et cetera, et cetera. But the most important people in the oil and gas companies now are the completion engineers, the drilling engineers, because you know exactly where the resource is. It's well mapped. There's enough wells. It's just how can we complete the wells? How can we manage the drilling? How can we manage the water use? How can we manage the fracs? How can we manage the logistics? in drilling and fracking horizontal wells. To the layperson, if they saw what it takes, they wouldn't believe it's possible. The amount of sand you have to move to, the whole thing about fracking is you build up enough pressure to crack the rock, and then you pump sand in to keep it open. So
it's pretty hard.
The millions of tons of sand that get moved every day. The oil and gas business is a remarkable business, and to be still learning and still evolving, it's quite remarkable and very fortunate.
Advice to a 30-year-old John Dielwart.
Take the risks. Don't be afraid. And it's fear. And successful people will say, and it's not that I've been that successful, but don't be afraid of failure. Sometimes not knowing everything isn't such a bad thing. But it's, I think I was just having this conversation with somebody, their son actually is in mechanical engineering at U of C right now. I said, well, what do you think he's going to want to do in his career? And he said, well, she's not sure, maybe oil and gas. And I said, you know what? I think the best time to get into oil and gas is right now. There was nobody going into the petroleum engineering discipline at U of C, so they mothballed it and they're bringing it back. The industry's gone through cycles of not enough talent coming in, and that shows up later. And I benefited from that in the early days. I was doing projects as a 3-year engineer that normally a 20-year engineer would have to be doing. So it's keep your eyes open, build strong relationships. We're in a relationship business. If you get the opportunity, and people ask me I think you even asked me what one of the things that I take the most amount of pride in. And the reality is providing opportunities for others, like a 30-year-old young John Dielwart or something, that you can give them an opportunity to be the best that they can be. And that's what building a company allows you to do. And not a lot of people get that opportunity. And if you have that opportunity, don't shy away. And be confident. Be confident in who you are and align yourself. The single smartest thing I did at ARC Resources was hire the best people that knew way more about, they were all subject matter experts. And every one of them knew more about their world than I did. But I was able to tie it all together with strategic vision and strategic thinking and whatnot. So it doesn't matter who you are. You will only be as strong as a team you're associated. Going back to, I think we were talking about the Blue Jays earlier. What's magic about the Blue Jays this year? You look at them after the win last night. All they kept talking about was each other.
Yeah,
it wasn't me. It was each other.
Yeah,
and that's what that's the environment you want to find. If you're a young person looking for a company to work for, you want a company that values your individuality, that values you as a person, and doesn't see you as a tool. One of the biggest, one of our key business cornerstones at ARC was people were our greatest asset. And I talked about that earlier. Mm-hmm. And there isn't a CEO on the planet that wouldn't say, well, people are the most important asset we have. Then as soon as there's a downturn, what's the first thing they do is they lay off their people.
Yep.
At ARC, we've never laid anyone off en masse. We've had course corrections, but if people are your number one asset, so you want to be in an organization that values the individual. And there's more of them today than existed when I came out, but I still don't think they're the predominant number. They're not the majority, because it'll still come down to whether it's a board or a management team says, I got to cut my OM&A, I got to cut my operating costs, so I got to cut people. Yeah. And good talent is the hardest thing to come by. And if it's coming wrong, you want to go to a company that people want to work for. You want to be a company. You want to build a company that people want to work for. And when you do, it's magic, like the Blue Jays. They are greater than the sum of their individuals.
Yep.
They got great people on the team, but they're more than that, and that's the environment you want to be in. Now, as a young person entering any industry, it may take you a while to tell one from the other. One of the great benefits I had in my career was 12 years as a consultant working for lots of CEOs. I saw the entire spectrum of CEO traits and characteristics. And I could tell, I knew exactly who I wouldn't want to work for. I knew exactly who I would want to work for.
Sure.
And I want to make sure when I have that opportunity, I'm in this camp that this is where people want to work. Because unfortunately, there's
A mix.
there's a mix. And you can be the hard driving, hard ass, if you want to call it, for short periods of time, but long term, that just doesn't work. My belief is, and my experience has been, that you want to care about your people as much as you care about your assets. And if you do, they will care about the company.
Yeah.
You know, one of the most amazing statistics, and we did a lot of work on leadership development. Again, a tribute to Mac and Phil Swift in particular at ARC Financial. We did a lot of work with leadership development, and it's a very purposeful activity. And the average company, and now I'm not talking oil and gas, but the average company in North America, in the world, Fortune 500, whatever you call it, the percentage point of actively engaged people is very small.
Yeah.
An actively engaged person, someone that comes to work every single day and wants to do the best for the company. The actively disengaged is at least as big and maybe bigger. And an actively disengaged person is not just somebody that doesn't really care about work, but they look to undermine the business. And then you got everything in between. So you need to really understand the health of your organization. And one of the things that created the success that ARC Resources has had and is continuing to have is we had an abnormally large percentage of actively engaged people and incredibly small. Every company's got somebody that is disgruntled for whatever reason. So building the culture and the work environment to get the best out of your people, and that's the environment you want to work in. You might have to work for a couple of other entities before you can really identify one from the other. But if you look at the companies that have had enduring success, you will see people-oriented strategies equally important to their business strategy, because it is their business strategy.
Yep.
And that's something that I learned by watching, and then it was aggressively reinforced from the culture at ARC Financial. That we were, and one of the greatest successes we had as a company, and me as a CEO, because the CEO, at the end of the day, tone at the top, whatever you want to call it, you're setting the bar.
Yeah.
Being able to create a culture that allows people to do the best they can, and people that want to work there. And boy, you take your eye off that ball for 5 minutes, and your culture can deteriorate rapidly. And what we were able to do during my tenure, and I know Myron carried it on, and Terry Anderson's carrying it on now, we're keeping that atmosphere of a great culture, putting talented people in an enriched environment, and you will outperform. There's no other outcome. Regardless of what the market throws at you, if you've got actively engaged people that care about the company as much as themselves, and not a lot of actively disengaged people, there's only one possible outcome. It's outperformance. Doesn't matter who you're, doesn't matter making widgets, factories, oil and gas, generating power. I don't care who you are. If you have that environment, those are the successful, enduring success. And that's what you got to look for, is enduring success, because fleeting success is all too common. Enduring success isn't very common, unfortunately. I think it's a little better now, but still, I think there's there's a ways to go. But the other thing that I would tell, I'd reinforce to a young John Dielwart, to get back to your question, and this is something that I talked when I mentor CEOs, when I even talk to people in the organization working for me, is don't be afraid to make a decision. And be prepared that it may not work out to be the right decision. The way we always looked at it, if you make a decision, if I've made a decision or you've made a decision, and you had all the information available and you made a sound reasoned judgment based on what you knew, and it didn't turn out that it worked that way, that's fine, because not everything's going to work. But if you make a hasty decision and there's data that you could have used that you didn't use,
Right.
shame on you. But once you've made a decision, don't second guess yourself. I go back to the example of the trust decision.
Too quick.
Yeah. Or be prepared to course correct. And what do successful companies do? They course correct more effectively. I was going to say faster, but I think it's more effectively than others. But I talk to people and they'd be second-guessing decisions they made 6, 12 months ago, even if it was to take a job at a particular company. I'd say, look, at the moment you made that choice, that was probably the right choice. In hindsight, not everything is going to turn out the way you wanted it, but don't let that hold you back from stepping out or making other. Be confident in the decisions you make. Understand you're not infallible, and that if you need to course correct, you course correct, because nobody's perfect, and nobody expects you to be perfect. The other thing I tell people is don't be prepared to say, I don't know, but I'll find out. As a CEO, if I go to somebody, I don't expect them to have every answer to every question I have, but I do expect them to be able to do the work required. And that's what I would tell investors when I'd go meet with them. I said, look, I'm not going to have all the answers for you. I'll tell you, this is the best information we have right now. But I won't have all the answers. And if I don't have the answer to the question you have, I'll get back to you on that. I've seen too many examples where not just CEOs, but people in leadership positions, or even people wanting to be leaders, think that they've got to have all the right answers at the right moment. And that should never be the expectation. But being able to look for the answer, and you may never find the complete answer, but be prepared to say, I don't know that, I'll get back to you on that. I did that so many times in my career, and the person sitting across the table respects that more than you trying to blow a bunch of air up there behind, right? Your job is to inform, not to try to talk beyond your knowledge. Yeah.
Well, speaking of enduring success, I think that kind of sums up ARC Resources in a nutshell, and I really appreciate your time today.
Yeah, and I appreciate the opportunity to tell the story. I know you've heard ARC's story from a few people, and there's nuances in there. And I appreciate the opportunity to talk about something that we're really proud of.
Next time we'll do part 2 on the rest of the nuances in the story, and maybe some more on power markets.
You bet. Happy to do it.
And thanks to Herb Pinder for connecting us.
Yeah, great guy, great board member.
That's it.
Okay.
If that works for you.
Thanks, Trevor.